Shop stock is flying high like a rocket ship. A year ago it was at $300, then it hit $400, $500, $700, $900, and now it's at $1,000 per share. So we're going to be taking a look at why it's so high, what do you need to know before investing in it, and whether it's at a good valuation right now. If you like this video, just make sure to drop a like and subscribe. It would mean a lot to me. And if you don't, Darth Vader is going to kill your portfolio's return. But other than that, let's get right into the video. First off, Shopstock is a solution to create your own e-commerce store for small businesses. Shopstock makes money by charging a monthly subscription fee to use their service, and they take a cut of every transaction one of their users' e-commerce store. Whenever a stock makes a big move in the short term, it's always important to see why it made such a big move, to see whether or not that movement was justified. Doing this can help us determine whether a stock is overvalued or undervalued. If you just assume that stock is overvalued because it's trading all the way at its 52-week high, you're gonna miss out on huge opportunities because that movement could have been justified. So it has recently exploded, or as I would say, turned into the Death Star, because of their ability to adapt to the changing e-commerce market. They now offer a 90-day free trial instead of their standard 14-day free trial. They increase gift card capabilities to small businesses on their cheaper subscription solutions. They allowed for integration of curbside delivery pickup, and more importantly, they recently announced that they're going to focus on expansion into the UK and Canadian markets. As of right now, they're mainly operating in the US market, so they're going to be focusing more now on diversifying their revenue streams. These additions make Shopstock a highly competitive business. They also had amazing numbers recently. From March to April, their platform grew by 60%. They had 45% growth in the number of new customers purchasing from small businesses who use Shopify. Not only are the small businesses making more money, but also Shopify is, because they get a cut of every transaction that takes place on one of the small businesses' e-commerce stores. And they saw over 40% revenue growth in Q1. So a lot of the upward movement with this stock is actually justified. The business also has very strong strengths that give them a strong edge over the competition. Specifically, they're very good at doing one very important thing in business, which is finding your niche and defining your unique value proposition. These terms essentially relate to the question, how is the business different from the competitors? What makes this business special and unique? Why should people buy from this business instead of the competition? Having a strong, unique value proposition makes it very easy to grow because you seem like the best alternative to the competition. And Shop has exactly that. They brand themselves on having the best e-commerce solution, while Wix, Weebly, Squarespace, and WordPress all pride themselves and brand themselves as the best solution for beginners for creating a general website. The difference is very slight between Shopify and the competitors' branding, but by positioning themselves as a better e-commerce solution over just a general website solution, business owners who are looking to sell and ship their product online are going to be choosing Shopify over Wix and Weebly 9 times out of 10. Just because Shopify prides themselves and says that they're the best e-commerce solution rather than just a general website solution. This gives Shopify a strong long-term competitive advantage. But this business does have some apparent weaknesses. First off, they serve mainly 3 types of customers: small businesses, medium-sized businesses, and the everyday Joe who got scammed into buying a course by an e-commerce guru and decided to purchase a Shopify subscription with that course. But seriously though, many small and medium-sized businesses have been under tremendous pressure, and Shopstock has said that many of the small and medium-sized businesses have been downgrading their Shopify subscription to a cheaper subscription so that they can save money and cut down on costs. And simply, these businesses are the most vulnerable right now, and many of them are just not going to make it, which is going to be disastrous for Shopify if they don't make it, because that's a long-term customer that they just lost. Also, most of their user growth comes from the average Joe, especially people who have free time on their hands. Many people purchase a Shopify subscription to start their own business online in hopes of quitting their 9-to-5 job, buying a Lambo, buying a Nintendo Switch, and playing Super Mario all day. But the problem is that those people really have zero experience in starting a business, and they fail very quickly, and they cancel their Shopify subscription very quickly, realizing that there's no way to get rich quick, except for the stock market, of course. But at the end of the day, most of their users and user growth won't materialize into long-term cash flow growth, because those users are not going to use their platform for a very long period of time, which undermines many of the growth metrics that I said earlier in this video. And not to mention that Shopstock does not appear to have economies of scale. Economies of scale is a phenomenon in business where revenues increase at a faster rate than costs as the business grows. For example, a business that has economies of scale double their costs but quadrupled their revenue. For example, from 2019 to 2020, Shopstock saw their cost of revenue and actual revenue increase by about 50%, which indicates that their costs and revenue are increasing at about the same rate. So as they grow more and more, they're not actually becoming more profitable. So it is unlikely that growing their business is actually going to make it more profitable. They have also admitted in their 2019 annual report that they are unlikely to see profitability in the short term. But analysts are expecting them to make 52 cents in EPS this year and 65 cents next year, while other analysts are expecting them to lose 42 cents in EPS this year and $1.82 next year, which shows that there's very little potential for bottom line net income growth in the next 1 to 2 years. But there's also a lot of downside potential in that they can lose a lot of money in the next few years. And given that their stock is trading at $1,000 right now, putting them at a forward PE ratio of 2,000, this stock is way too overvalued for its growth potential, and it needs to come down faster than a falling rock. The company is phenomenal in terms of creating a good business, but the risk of this as an investment is much greater than the reward, as the stock is trading too high of a PE ratio to justify its future growth. But make sure to like and subscribe. I hope this helped you out a lot.